Hello, everyone, and welcome back to another episode of the Integrating Investor. I am Seth Levine of the Integrating Investor, as most of you should know. And if not, welcome to the show. We are, as you guys know, we are on a journey here to redefine money and banking, and we're not doing this for fun, right? We're doing this because I think it's at least going to help us understand markets and the economy and ultimately be better investors at the end of it. Well, this is the big payoff. We've really struggled through through six parts up to now, and now we're on part seven, and this is the final piece. So thank you for sticking with me through this journey. And yeah, I hope it's been illuminating for everyone. I hope it makes sense. And if it doesn't, please let me know, because I would like to correct my mistakes. Next week, we have another great guest lined up. I'm going to be interviewing Corey Hofstein. He's the Chief Investment Officer of Newfound Research. It's another quantitative shop. He's a great guy, and I think it'll be a really interesting interview as well. As always, please like and share this episode. Just hit that like button right now. In fact, I may do it myself as soon as I finish with this episode. Just so you don't have to forget it, and help get the word out. You can follow me on Twitter and like a little bit on Instagram if you're into that. And of course, the website. Go to the website, check out all the articles that I write on a monthly basis. Subscribe to get those sent to you directly. And of course, we got the super chat. Please use that super chat function if you have any questions as we keep going forward. And as always, you have any questions, you have any show topics or guest suggestions, you can always email me at info@integratinginvestor.com. That's info@integratinginvestor.com. And yeah, that is that. So we are going to move right along with our show. And as always, we will start off with the lovely disclaimer. Again, these are just my personal opinions, not investment advice at all. Do your own work. I don't know. There's really nothing investing related here, but there's a disclaimer. You proceed at your own risk, as always. So what we're going to do on today's show is, as always, we'll start with a recap of what we did last week. And then I'm looking forward to wrapping up our dive into money and banking. And we're going to, on today's show, to kind of put a bow on all this, we're going to connect the Fed's actions, so the Federal Reserve, to higher debt levels in the U.S. economy. So this is where I think the rubber meets the road with our modern day financial system and central banking. Really, higher debt levels is my view, or at least what I can, in my analysis, I should say, where I see everything tying together. And I also see fiat currency playing a pretty big role in that as well. So let's start with the recap. So last week, we talked about what the Fed actually does. We tried to debunk some of the myths surrounding the Fed and the sort of powers that it allegedly has. I just tried to look at the actual mechanism that it employs. But the Fed is really just another market participant. It buys and sells securities in the public markets. Albeit now, for sure, it's a very large market participant, and it has non-economic really motivations behind it. And that makes it a little bit weird. But whether it's the Fed funds rate, quantitative easing, or any of the other very recent market interventions that it undertook as related to COVID, it's doing all of it's taking all of its actions in the investment markets. Now we saw that the Fed cannot print money, right? It has these things called reserves that it plays around with, but that's not money, right? Money is production. Money is tied to the actual real world and bringing forth things into it. The Fed cannot ease credit conditions at all by printing money or not. Again, the credit conditions are dictated by private banks and private lenders and private lendees. And above all, the Fed cannot dictate prosperity despite all its grandstanding. All of these are just assumed consequences of the Fed intervening in these markets. But we saw how those assumptions are just blatantly wrong, right? I cited a couple studies with the Fed reserves and inflation and reserve growth and commercial asset growth. But despite all these pretty obvious, data points, they're still wide. The Fed's powers are still pretty widely held today. Now, the Fed's importance, and really all central banks' importance today, is much less than in the past because of the shadow banking system, right? These are the scary shadow banks, those financial institutions that really operate outside the purview of the central banks. The Fed does, however, impact the cost of carry, and specifically the cost of carry of its member banks directly. And by the cost of carry, I mean the cost of borrowing money, right? Banks are levered entities. They employ a carry trade framework. They borrow money in order to lend the money, and they earn the spread in between the two sides of that trade. So the member banks can access Fed funds directly, right? There is a member bank, and if you have any questions on that, we'll talk about that. Feel free to ask. But also the whole shadow banking system, which operates outside of the central banks, there's a connection to all these various money markets because the Fed is interacting in the money markets, specifically short-term treasuries, but that also impacts LIBOR, which doesn't really matter as much anymore, but a lot of the short-term money rates. Now, this has important ramifications, and this is clear because of our carry trade framework. In my view, by lowering the cost of capital, right, by lowering the cost to borrow in a carry trade, you are encouraging leverage. You are encouraging debt creation. And that's what I think we'll see today. And this is really the only material, long-lasting impact that I think the Federal Reserve has on the US economy. And of course, it's very harmful because it lowers productivity, because we have higher debt levels, it lowers prosperity as a result, and also it increases instability in financial markets and the economy. Now, to try and illustrate this, I'd like to do a thought experiment first. Let's imagine there is no central bank. I know, just don't get caught up in your fantasies, everybody. This is only a thought experiment, right? So we have this carry trade framework for banking, and this is going to just, I think, be very illuminating. Right? Because banks, so we have a financial system only comprised of private banks. Now we know that banks borrow money in order to lend, and they employ leverage as a result of this. Because of this, this is going to make them very sensitive to changes in security prices and asset yields, right? Because they have to manage the two sides of that trade with leverage. Again, if you have questions on this, feel free to ask. Just a little bit higher level of financial concepts that I'm touching upon here. But because of this leverage, managing liquidity is paramount for a financial service company or bank. Right? The bank has to manage the liquidity so that it doesn't have to unwind its carry trade. So when we have times of stress, right, whether market stress, economic stress, whatever you want to say, the cost of that borrow will increase. And this is for a couple reasons. Either banks need capital because they're experiencing losses on their lending book. Now, it could also be that they're getting nervous, or investors are getting nervous because of the potential for losses. So losses may not even happening, but maybe the potential for losses is increasing because we're getting into a less favorable economic outlook. Because of this, the demand for capital is going to increase. Now, as the demand for capital is going to increase, the supply of capital is going to decrease. And this is because investors are going to view banks as less risky. So they're not going to be, as likely to lend or as happy to lend to banks, at least not at the same price, right? The price is going to increase. So the cost of capital is going to rise for banks. Now, borrowing costs in this competitive banking framework is a real competitive advantage for anyone using a carry trade framework. So if the cost of carry increases above what the asset yield is increasing, or if the asset yield is even going down because of losses, right? It's depleting because of losses, your carry trades are going to unwind. And what that means if you're an entity, if you're a bank, well, you lose your entire business because all of a sudden you're having people coming in wanting money. You don't have that money because you've lent it out. And you have to start selling your assets. And you have to sell a lot of assets too because you're leveraged. And this is exactly what a bank run is. So in this scenario, you see runs of the bank. And this is precisely what the great financial crisis was. This is exactly what happened with long-term capital management. And in fact, it's exactly what happens with every famous bank and investment fund failure in the history of, financial markets. Now, for this reason, banks need to publicly show solvency. They need to do it for a business reason. They need to do it because they need people not to panic if they're solvent, because they need to manage their liquidity. And this is really the origin of the whole conservative banker image. They need to make sure they have access to capital, low borrowing costs, and really they need this to keep their business together. In other words, there's an incentive mechanism here for having a sound financial system. Now we can end that thought experiment there for a minute because this is not the world in which we live, right? We live in a world of central banks and fiat currencies. And quite honestly, in my view, both completely eviscerate or at least short circuit that market mechanism to keep the financial system conservative and leverage in check. Now, as we saw, what is the cost of capital for the Fed? Right? We're talking about the Federal Reserve specifically. Let's keep it that way. What is the cost of capital for the Fed? Well, it's zero, right? Because it just prints up these reserves, right, out of thin air. Now, obviously, this is not the case for other banks, right? Other banks need liquidity. Now, they can access the Fed, but there's still a cost of capital associated with that. Because the Fed has a zero cost of capital, this makes the Fed the de facto lender of last resort because it can always print up its own liquidity. It can always lend out to other banks. And because the cost of that is zero, it's always going to be profitable for the Fed to do that. Right? The Fed prints reserves, but note that that is not money. And we'll put that aside for a second, right? And we talked about that last week. So because there's zero cost of capital for the Fed, and the Fed can be the lender of last resort, it can always provide liquidity to banks. And if it can always provide liquidity to banks profitably, well, then these carry trades that the banks are engaged in, they never unwind, no matter how bad their behavior is, no matter how just that may be. Central banks, as a lender of last resort, now let's just take a step back. You may say, okay, well, we have a lender of last resort, like, maybe there are times that good banks, maybe just, the public can't see that there's solvency that the bank is solvent and really deserves to survive, right, for whatever reason. Well, that's real nice. And that's true. And in fact, this was tried to be addressed by Walter Bagehot in the late 1800s in his book Lombard Street, where Bagehot was trying to bridge the gap between a world with a central bank and a decentralized private banking world. He liked the latter, but he was trying to bridge those two worlds. And he said, well, you can have a central bank so long as they're only saving solvent banks. And again, we'll put that aside. You have questions on that. Happy to answer that afterwards. But that's just not the way we've seen the empirical evidence work out at all. Right? When we have central banks as lender of last resorts, they don't distinguish between solvent and insolvent banks at all. And we saw this explicitly in the Great Financial Crisis in the US. This was an explicit goal of TARP. Now, if you remember TARP, all the banks were all the big banks were essentially given bailout money by the Fed and the Treasury. The banks could not refuse it. They couldn't refuse it because the government didn't want to single out any banks as being weak. So it cast them all with the same stone, or the same, whatever the right analogy is, right? In other words, there was no upside for running a great business, and there was no downside for running an awful business. You were all treated the same in the end. But what does that do? Well, it creates poor incentives and incentivizes basically risk taking, since the downside is all the same. So why not swing for the biggest, swing for the fences all day long? Right. When we have the Fed making as the lender of last resort, and we have fiat currency, right? There's no cost for lending. We see that politics, rather than economics, dictate decisions. What does this lead to? Well, obviously moral hazard, but even more ugly than moral hazard. I know, right? Like, what is more ugly than moral hazard? It creates cronyism. And this is, in my view, so important, because the world in which we live that just hates on the financial system and hates on bankers, that blames capitalism, completely ignores the fact of what I just went through, that it's really the central banks, regulations, obviously, and the fiat currency regime that really amplifies cronyism. So it's both the Fed and fiat currencies that facilitate these non-economic bailouts. And again, it's due to the zero cost of capital and politics replacing economics as capital allocators. So banks never deleverage their bad mistakes. They never unwind any of the leverage that they've employed in the economy. Whew. So with that, let's take a quick break here and check the super chat. Jonathan, what is up, my friend? Thank you so much for the super chat donation as usual. Thanks for being a supporter of the show. Robert, Robert, hey, what's going on? When is Jeff Snyder coming on? We will see about that. But thanks for asking. I actually learned, I have a lot of, so Jeff Snyder is the Chief Investment Officer of Alhambra Partners. I like Jeff. Jeff really did I have a lot to thank Jeff for the framework of this, or my education of this Eurodollar. He calls it the Eurodollar system. I call it the shadow banking system. I have Jeff to thank a lot on that, but it's interesting. I see things very differently than how Jeff sees things overall, even despite, his, but do have a lot to thank him for, a lot of my own knowledge that I attribute to him. So where were I? All right. So let's put that thought experiment aside for a second And let's come back to the world in which we live. So this is a chart I pulled up. And it shows, so this is the red line is the debt to GDP in the US. And the blue line here is the effective Fed funds rate. So that's the Fed rate, right? What you can see here is just the red line has just exploded, specifically, after kind of the 80s. It's just, the debt to GDP has, throughout the entire economy has really just gone up and to the right. And at that same time, it's, you look at the blue line, like rates have just completely fallen. Specifically short end rates have completely fallen. I also noted some points here too. 1971, we saw Nixon close the gold window. This is when the US came off of the Bretton Woods framework and we went to a true fiat currency regime. You could see, not a one-to-one correlation here, but things sort of, the debt load does pick up after that. But also, in 1979, we saw Paul Volcker, the Fed chairman at the time, increase rates to break the bank of inflation, right? And we see that has maybe a marginal impact on this debt growth over time. But again, it just completely exploded as our blue line fell, over the past, 40 years or so, in part due to the Fed completely dropping rates. Now, I see a link between this debt growth, the low rates, and fiat currency that I've been kind of alluding to, if you haven't caught on already. And this is really all illuminated by our new framework of money and banking. Now, the Fed isn't the only entity to blame for this rise in leverage, at least directly. As I touched upon in last week's show, we saw the shadow banking system really develop and explode in the beginning in the early 1980s, and this was a result of Regulation Q, right, that opened up, changed the liquidity requirements. So the expansion of the shadow banking system, as we'll see, created more banks who were willing to lend. There's just more banks who are willing to provide leverage in the economy. So it's no surprise that we would see lending and borrowing increase with more banks. But there's a very important connection to falling rates here, right? When interest rates fall, when the cost of borrowing falls for banks, and specifically short-term rates that we could touch on if you have any questions on, well, that makes carry chains really, really profitable. Because rates fell for 40 years and carry trades were profitable for these 40 years, well, no surprise, we saw more shadow banks. We saw shadow banks increase in amounts over the last 40 years. Duh, right? And this is the carry trade framework. So we have the interest rate component in the rise of leverage. But over this time too, we also saw the rise in Fed activism. Right, the Fed started to intervene in or at least take more of an interest in financial markets. This is most famous with the Greenspan put. Right, this connotes kind of Alan Greenspan really trying to prop up markets by lowering rates, in the late 90s. And the Greenspan put was basically, what's the right word? It was inherited by Bernanke and became the Bernanke put. That Janet Yellen ran with that too. It became the Yellen put. And now we have the Powell put, right? Each Fed president since Greenspan has really been hyper focused on investment markets and their stability. And every time there's a financial market quake, you see them very quick to lower rates. Now, it's highly debatable how much power, in my view, the Fed really has to stabilize rates. and the investment markets along with that. But what's not debatable is that a falling cost of capital for funds boosts profits for shadow banks and incentivizes more lending based upon this carry trade framework. What's not debatable is that an increase in bailouts related to financial crisis turmoil has occurred over this time frame. So this cheap liquidity that the Fed was providing was really forestalling the need to undergo painful deleveraging by the banks, by the financial system, by the economy to address lending mistakes, right? To address this misallocation of capital that was happening. Rather than seeing creative destruction that we would have seen, it was all, the cleaning up of the market and losses were not only delayed because liquidity was injected into the banking system, but it was compounded. So this leverage, in order to address the leverage mistakes, we had to add more leverage in order to bring in more asset yield to account for the mistakes. And think about that. Borrow, earn. The cost to carry, my asset yield. My asset yield is going to go down because we are going to have losses. We've made mistakes in the asset yield. So we need more assets that we bring on via leverage in order to return that asset yields to stabilize the cost to borrow, the relationship between the cost to borrow and the cost of capital. However, at the same time, rates are falling, which means we need even more assets on top of what we even would have need, on top of what we needed in that scenario to create more investment dollars. So we're compounding mistake upon mistake upon mistake. And as a result, leverage is increasing. So because the financial system can be thought of as this giant carry trade, the Fed's proclivity for providing cheap liquidity is encouraging debt growth, in my view. Now, this is the payoff. Like this, we really can start to piece together, in my view, how the Fed's impact, right? What the Fed is doing impacts investment markets and it impacts the economy. This exercise that we've done, starting with money, shed light on how the Fed operates, and that's how it actually impacts markets and investment markets and the economy. Right? We stripped away all the myths and we just looked at the mechanics. And of course, we needed to start with banking because we're talking about central banks. And if you want to start with banking, you have to start with money. And this is because banks are levered entities. They borrow to lend. And we see that money is created only by private banks. And what the Fed is doing is really providing liquidity, not money per se, right? Not real production. Now, banks fail because of a lack of liquidity, right? This lack of liquidity is really a, what's the word I'm looking for? It's really an inability to pay their cost of borrow. So what banks have to do, because they don't have the liquidity to make those borrowing payments, right? They have to sell assets, right? They are forced sellers. They have to unwind these levered trades. So because banks are managing liquidity, any banking problem can be fixed by a liquidity injection. In fact, that's the only way to stem banking problems at all. But when you do this, you prevent them from deleveraging. And as a result, the rest of the economy from deleveraging. And as a result, you're really encouraging a re-leveraging of banks and of the economies, despite the economic conditions dictating otherwise. Now, as we saw, the Fed is a banker's bank. The only interaction with the rest of the economy is via other commercial banks. This is how it accomplishes its so-called goals. Right? It doesn't do anything else. The Fed doesn't really hire people. It can't really affect employment. How does it affect employment? How does it affect stable prices? Well, really just by injecting and removing liquidity into member banks. So we can see how absurd all these Fed goals are, because how disconnected what the Fed actually does to what it thinks it can do. And that whole connection there's a theory that all stems from a flawed view of money. It's putting the cart before the horse. There's a belief that if you impact money, you can dictate outcomes. But as we saw, money is a veil. Money is nothing more than a result of, or rather a indicator of what is going on in the real economy. You can't change that. You can't change the money and assume that you're going to see effects in the real world. All the Fed can do is swap its reserves with member banks. Now, it's mainly for US Treasuries and mortgage-backed securities, and this is via the short term. Now it can do so. Now it can actually buy bonds and ETFs, so there's an impact there. But reserves are only useful for banks. It's only useful for banks for liquidity purposes. You and I don't have a use for bank reserves, right? We can't even access bank reserves. It's really only member banks. So the Fed can only provide liquidity to banks. The Fed is only a liquidity provider to banks. That is all it does. Right? These reserves are created out of thin air at no cost. So the Fed can always provide liquidity to banks for a profit. And this is a competitive advantage over other banks, which have a cost of capital. So this is going to make the Fed the de facto lender of last resort, no matter what. And interestingly, of course, we've never had another lender of last resort, right? We never had that panic of 1907 scenario where JP Morgan, the financier, came in and bailed out the financial system and did so at a profit. We now have the Federal Reserve to do that. Now, of course, this is only possible because we live in a fiat currency regime, right? Regimes are currency and they're costless, but they're not meaningless. And that's important. They have a use for member banks. They allow banks to meet their liquidity mandates. Now, of course, this fiat currency regime with central banks creates perverse incentives, right? Why not save the banks, right? Whenever there's a problem, why not bail out banks? It costs nothing, right? All it costs is reserves. We just print them out, give them to the bank is fine. And it avoids painful losses, right? There's always someone who's going to get hurt by a bank failure. Now, that doesn't even get into the fact of cronyism. Let's just put that aside. Now, of course, this creates moral hazard. And it creates moral hazard because you now have an incentive to always lend for risky enterprises, and the riskier the better. Why? Because the riskier your lending and exercise, the more profitable your trade can be. And if there's no downside, why not? And again, this puts politics over economics as the main factor of bailouts. Right? Why was Bear Stearns saved in the great financial crisis, but Lehman was left to fail? Why was AIG charged a really high rate for its bailout funds, while Goldman Sachs and Morgan Stanley paid practically nothing? Well, again, we are creating conditions ripe for cronyism. And when it happens in the financial system, something worse happens. We create this politically created cronyism with capitalism. Now, as I noted, we live in an era of increased central bank activism. right? The Fed reflexively provides liquidity to any problem it sees in the world. And, when you're a hammer, well, I guess all problems are nails, right? That's not so surprising. But it's really harmful. Why? Because it prevents the required deleveraging from occurring, right? These bank failures are happening for a reason. But worse than just not allowing mistakes to be realized, it encourages a releveraging as the remedy. So we enter into these periods of increasing debt loads in the economy, which is what I believe is happening today. Now, obviously, we're circuiting the invisible hands of markets, and we're perpetuating the financial markets carry trade. And we have great examples of these in today. Look at Greece as a result. Look at Greece as a result of the European bank crisis that happened a couple of years ago. Greece was failing, and what was the result? More debt. What is Greece now? Ton of debt. Has it solved its problems? Not at all. We've just kicked the can down the road. Another shining example is Citibank, right? Citigroup today. That is what, it has failed many times, multiple times throughout modern history. Why? Because when it fails, it gets bailed out, it piles on more debt as a result, and it just happens again. Now, the result of this, of course, extends beyond the whole Greenspan put and central bank activism, but in my view, to fiat currencies. And the myths of the central bank are only getting even more absurd today. I mean, to this day, the central banks are talking about tackling climate change, tackling inequality. I mean, this is completely absurd because what is the Fed? What are central banks? They're bankers' banks that the Fed specifically operates by helping them manage liquidity. Can that really impact climate change, whether or not you believe that to be the case? Can it really impact inequality? Right? It's just completely absurd. The Fed cannot control any outcomes. And this should be obvious by its explicit failures with respect to inflation targets and all its other economic real-world impacts that it professedly is after. And this is because of how the Fed interacts with the real economy. It's just one other actor in investment markets that are extremely diverse and a dynamic economy. Ultimately, all the Fed ultimately, all the Fed's actions just creates more and more debt creation. And again, it goes back to preventing banks, which are levered carry trades, from unwinding. So running a little bit long today, but we can finally sum everything up. We can finally move on from this topic. Now, it's been excruciating. I mean, it's taken us 7 episodes to talk about money and banking and central banking and economies and carry trades. But I hope it's paid off, because by cleaning up our definition of money, it's really illuminated a lot of confusion with respect to like money and policy, for example. We can see why adding dollars or adding reserves doesn't really affect economic outcomes. And then we could see why modern policy is so ineffective and, in my view, outright harmful. We could see why inflation as a concept really makes not a lot of sense in a fiat currency regime when we're talking about that classical version of monetary debasement. We can also see why fiat currencies collapse, right? Because fiat currencies, the currency becomes disconnected from money. This is the problem. Currencies, which are not, when we separate the concepts of currency and money, we can see how printing more currencies that are not tied to the real world production, aka money, why those currencies become worthless over time and completely collapse. Right? We could see why the Fed is completely ineffective at at achieving its goals in the real world because all it affects is bank liquidity. And here today we saw why why debt has just continued to grow in this period of fiat currency and increased central bank activism. So from here, I also hope that it's obvious what the remedies are. When we live in these times of high debt, there's really only two choices. You can either restructure the debt, and you could do that either by default or via, the more obvious case, by inflation, right? And inflation here, I mean the currency debasement. Or the preferred way, which is the way that we try and go about this, but we don't do it in the right manner, would be to increase the asset yield, right? Think of a carry trade again. If you have too much debt in a carry trade, it's going to unwind. In order to prevent that unwinding, though, you can either fix your borrowing costs, which we're not going to do, or probably not going to do through restructuring the debt, or we can hope to generate more yield from our assets. And when we're talking about the economy, that means economic growth. That to me is the preferable path. But in order to get more economic growth, what do we need? Well, to me, it's clear. We need more economic freedom. This is why I'm such a proponent for capitalism, among various reasons, but here's just another reason. If we could free up regulation, free up the economies, free up our economy, free up producers to produce more, well, hopefully we can generate enough growth and asset yield to work our way out of this period of high debt. Wow. So thanks a lot for sticking with me through this very high, through this long, this long multi-part of series on money and banking. Jonathan, thank you so much for your super chat donation again. You've been a huge supporter of me. I really appreciate that. Just looking real quickly, how is the Fed providing liquidity again? So the Fed provides liquidity by printing reserves out of thin air. If I'm a bank, I can basically go out and get reserves. How can I do that? I have to sell an asset. So it's not, purely out of thin air, right? From the bank's perspectives, it's not out of thin air, but you can increase the reserves by just from the Fed printing them. Now, how do we bridge that gap, right? Because in order to get a reserve, if you're a bank, you have to sell an asset. It would seem that there has to be connection to assets and reserves, right? Because for every buy of reserves, you need to sell something. So how can you receive more of a sale from what you're buying? Again, there's one answer: leverage. In order to do that, we have to see leverage increase. And that is another way that, again, is fitting into this carry trade framework, right? If you want to get some of your reserves, what do you have to do? You have to increase your leverage in order to do so. And that's what banks are doing today, in my view. So I hope that answers that question. So with that, thank you, everyone. Thank you, Jonathan, on the super chat. Thank you, Robert, for your questions. Thank you, everyone, for sticking with me. It's been an incredibly dense topic, but I think there's something here. I think we're seeing a new perspective and a new light, seeing a new perspective and shedding some light on real problems in the world, both in the economy and also with central banks and fiat currency. But we're framing them in a way that I don't think anyone else is addressing. And to me, seems to be, it at least makes sense to me. So I hope it makes sense to you as well. And with that, we're going to drop money, central bank and central banking and banking. We're going to come back with a great guest next week. I hope you guys will join me. Hope you have an incredible weekend. And don't forget to hit that like button as always. I hope you liked it. And I will see you all next week. Take care, everyone.